Hello. I feel bad for eating online, but if I don't eat, I'm too weak to study. But if I chill and I eat, it becomes that much more difficult to study. You guys following oil and what's happening in Iran? Hello. Are you guys following oil and the Iran war? Any exciting insights? I was saying sorry for eating online. If you don't eat at your desk, then studying becomes that much more difficult. I'm always excited to get home, back to my calculator. Hey guys. Yeah, I'm good. Just super hungry. How are you guys? Have you guys been following what's happening to oil? What do you think that means for CPI? Do you know that oil feeds into obviously transport, which is about 4.1% of the CPI basket from Stats SA? But what also goes through the Strait of Hormuz is also agricultural byproducts. Maybe byproduct isn't the right word. So oil is fossil fuels, right? So from fossil fuels, you also get like ammonium and other things. My physics and my chemistry isn't good, but fertilizer comes from that, which means food production and crops and food security in is threatened. And food is about 16.8% of the basket. Hi. So you've got transport at 4.1, which is obviously underlying to everything. And then you've also got, what's her name? You've also got the fertilizer, which is 17%. So that's 21% of the basket that's going to be like very uncertain. And Lesecha and gang are sitting on the 26th for the MPC meeting. And in the previous meeting, they didn't cut. And now we've got this geopolitical whirlwind directly threatening about 21% of the basket. What do you guys think? Can I ask you a question? Yeah, you can ask. What's your question? No, but that's macro. So there's microeconomics and then there's macroeconomics. And utility is very important. I mean, e-utility in a competitive advantage speaks directly to why EUS is instituting or instigating this war against Iran, because Iran and other Gulf countries have competitive advantage when it comes to producing oil. And United States has an inflation problem and they want oil prices to be lower globally. So it's not that varsity economics isn't important. It's just you're not at that level yet. You're still building. It's hard to believe that oil started the year at like 60. It's at 84 now. 82. Well, it touched 84 today, but it closed at about 82. You guys must ask away. Once I'm done eating, I'm gonna start studying. Today's a cheat day. I'm cheating on bad cool drink and bad what's the name? And bad food. What keeps me going? Hi, Lisa. I like money. I really like money. It's as simple as that. I've always wanted to have money so that I could buy my own things, so that I could travel, so that I could have a house, so that I could have a car, so that I could have a TV. And I think that's the kind of life my career affords. So that keeps me going. Okay, guys, let's go. Sorry, my mom was calling me.
Okay, welcome back, and now we're going to talk about valuation of bonds with embedded options. We're going to use the binomial tree framework. And remember, the binomial interest rate tree, the probabilities of up and down are 50-50. So recall that from our previous reading. And also recognize that when you use binomial tree, we are using what is called as a backward induction, work backwards from end to today or time zero. And let's get to an example right away. So there are two LOSs that we're going to talk about. Mainly, it's a calculation of value of a callable or puttable bond, and we'll see how to do this in the context of a binomial interest rate tree. All right. So the backward induction process that we have already learned. Remember, we take because it is 50-50 probability, we take average of the two values feeding into a node and take the present value based on the interest on the specified for that node. And don't forget, we have to include the coupon also. So that is a common mistake. I mentioned it when we went through the binomial.
Is anyone else studying?
Tree backward induction process the first time. Okay. Now, so if the bond is callable, if there is an embedded option, specifically a call option, if the bond is callable, then, and assuming that the option is exercisable at that point in time. Remember, if it is a European or Bermudan option, it will be exercisable at
Anytime.
specific points in time.
But
And
American
that will be
option
given
is
to
at
you
any time.
in the question itself. So only for those nodes where the option can be exercised, what you do is you substitute the value for calculated for a node with the call price if the call price is lower. So whichever is lower. And so the assumption is the issuer is going to exercise the option, call back the bond, and you only get the call price. That's the assumption that you're going to use. So you always assume that the option will be exercised when it is exercisable if it is in the money. That's the straightforward assumption. For a puttable bond, you substitute with the higher value. So the value you calculate versus the put price, whichever is higher. So 3-step, first identify when the option can be exercised, what time points in your binomial tree, and then identify if the option is in the money. If so, then use the call price or put price as applicable. Otherwise, leave the calculated value as it is. All right, so we'll look at an example. You are given a 2-year bond. Bond with a coupon of 7%. So, I mean, we don't need 3 values there. They're all the same. That maturity, the par value plus the last coupon. And so for the first point, we are going to just take 107 divided by 1.088% is the interest rate in the top node. Similarly, for this bottom node, it'll be 107 divided by those two, add this on, and then that is for the straight bond. And let's see what those values are. The bottom value, bottom node at t equals 1, those two is $100.08, I think. 40% discounted for 1 period. period at 3%, and you get 104.35. So going back one slide, sorry, you are given in choice 2 is the bond will be callable in 1 year at par. So the option is exercisable at T1. Similarly, for puttable bond, it is also exercisable in year 1. And then value the call option and put option. So straight bond 104.35. Pretty straightforward. Now, for a callable bond, before the fact, anytime I'm calculating the value for the bottom, what I'm going to do is I still go through the same process of backward 99.54 plus $7 and discount the 3. So that difference between the straight bond value 104.35 and 103.43, that is the value of the call option. And so that was a callable bond valuation using a binomial interest rate tree. Pretty basic, pretty straightforward once you have backward induction calculating. So remember that's bottom node alone, because for a puttable bond, only choose the higher of the two values. In this case, the bottom node, the higher value is 101.90, so you leave it alone. All right, now you take the average of the $100 and 101.90, and then you are going to add the $7 coupon and discount it at 3%. And you get 104.81 as your puttable bond value. As you can imagine, it will be higher than the straight bond value. Anytime the option is exercised in our tree, the resulting value you get is going to be higher for a puttable bond. So the difference between 104.81 and 104.35, the straight bond price, is the value of the put option. So the call option value was 92 cents. The put option value is 46 cents. Based on our example, based on the numbers in our example. So that is the valuation of the embedded option. You don't value them separately. You value the callable bond and then subtract the value from straight bond value. All right. Let's look at a few questions from the curriculum. George Cahill, the portfolio manager, has identified 3 5-year annual coupon bonds issued by a sovereign government. They are identical in all respects except that bond A is an option-free or straight bond. So that is bond A. Bond B is callable in 2 years' time. These are 5-year bonds. So it's a Bermudan option, so it is callable in 2 and 3 years. Bond C is also callable in 2 years and 3 years, but it will be puttable at par 1 year from today. So it is basically bond C is bond B plus a put option, right? So those are the 3 bonds that we need to be remembering while answering the questions that follow. All right, so first question is, that follow. All right.
Relative to the value of bond A, the value of bond B is the callable So a callable bond value is so a callable bond has a discount. So I think the value's lower. Okay, so I'm saying lower.
So, first question is, relative to the value of bond A, the value of bond B is what? So bond A is straight or option free, and bond B is the callable bond.
Yeah.
So bond B will be worth less because remember again, the investor is short the option, so they're willing to pay less to have.
Yeah, because the call is the issuer's what's the name? Benefit.
That option embedded. So bond B is callable, and therefore you subtract the value of the embedded call option from the value of straight, which results in a lower value. All right. The next question is relative to bond B, the value of bond C. Remember, bond C is bond B plus the value of the put option. So bond C should be worth higher, again, because of that valuable put option. Whether you end up exercising, we don't know, but still, everything else is the same.
Relative, the value of bond C is, so bond C is the one with the call and the put. So you're comparing a bond and put combo to a straight bond, to a callable bond. So a put trades at a premium because you've got the benefit of selling back the bond at a certain price. So the put option makes it, more valuable than a call option, or the put and the call provision rather. Yeah.
bond C would command a higher price than bond B. Finally, given an anticipation of rising interest rate,
given an anticipation of rising interest rates, bond C, which is callable and puttable, will be expected to be called by the issuer. A, no, because issuers only call when rates decrease, so that they can refinance at lower rates. B, be put by the bondholders. Yes, when rates increase, bond prices go down, so bondholders will sell the bonds, go back into the market, and get higher yielding bonds. C, mature without exercise of any of the embedded options. I think it's B, be put by the bondholders.
Will be expected to what? Remember, bond C is callable as well as puttable. All right. If your rates are rising, will the company call back the bond? No. Remember, when rates are rising, the bond price is dropping. The investor does not, the issuer, does not want to refinance at a higher rate, so they're not going to call back the bond. So the call option will not be exercised, but the put option that is also included for bond C will be potentially exercised. So the correct answer is choice B, will be maybe put by the bondholders.
Yeah. I've had such a long day. Yeah.
Again, depending on how much the rates rise and what is the impact on the value of the bond. All right, so that is it for this module. We'll continue with additional binomial tree calculations in the next one.
He didn't say keep up the good work. I like it when he says keep up the good work. Okay, I've got a quiz. Let's quickly do the quiz. Yeah, I can feel my tiredness is here. I don't know how to explain it. Where's my quiz? Which of the following statements concerning the calculation of a value at a node in a binomial interest rate tree is most accurate? The value of each node is the present value of the two possible values from the next period. Average of the present values of the two possible values for the next period. Sum of the present value of the two possible values from the next. So it's the average. Oh, they've got one. Okay, option 3. So this is question 2. So n is 2. Payment is 12. Okay, so V1 up. It's option 3. So 100 plus 12. 1 plus 7, come on, 1, 8, 2, 6. plus 100 plus 12. Oh, that's just it, sorry. V1 low, 100 plus 12, 1 plus 5, comma 3, 2, 1, and then 2, 2, 6, 6, 2, 3, 6 plus 12 plus 4, comma 5, 7, 4, 9, 106, comma 2, 4, 1, 6 plus 12 plus 4, comma 5, 7, 4, 9 plus 12 plus 4, comma 5, 7, 4, 3, comma 1, 6, 4, see. I like looking up in my answers there. Oh, okay. Callable at 105 at the end of year 1. Call when interest is low and prices are high. Therefore, I'm gonna take the lower one for call. Yeah. Yeah, so the prices must be kept. Yeah. So the issuer calls when interest is, what's wrong? When interest is low and prices are high. Yeah, I was right. Yield is low and price is high. So yeah, when yields go down here, therefore V0, V1 up. That's gonna stay that 104. That one was quite involved. Put, so that's for issuer benefit. Trades at a premium, right? You put when bond yields are high, reinvest proceeds of sold bond in market. Okay, so V1 up will be 105. Call when it's low. Yeah. V1 low, 106. 416. Yeah. V0 will then be a half. 1 plus 1. 4.575. The put option trades at a premium, and it's for the benefit of the issuer. So it's gonna be straight minus puttable, because the puttable is gonna be the straight. It's gonna be positive, so V puttable minus V straight. Yeah, puttable. 112,523. Straight minimum. 113. 2813. What to say? Puttable. See, puttable. Oh, it is positive. No point 24. Therefore, I got 100% for valuing bonds with embedded options. The world is my oyster. Okay. Need to go to part 2 of the module. Yeah. I am so tired. Yo. Yo. Okay. After this, I'm gonna do the master class. After the master class, I'm gonna do the quiz, and then I'm gonna log off. I've been working since 6:30. What is that? About 14 hours. Yeah. Yeah. I'm gonna finish this, then I'm gonna do the master class, do the quiz, and then I'm done for the like I'm tired. I'm actually gonna put this in the fridge. Go put it. Ouch. Oh god. Ouch.
Okay, friends, welcome back. And rather short module here. We're going to talk about how the changes in interest rates affect the value of embedded option. So the first thing we're going to talk about impact of volatility. And here, when we're talking about volatility, is the real volatility in the market, not imagined volatility or an analyst's assumed level of volatility that they use in generating the binomial tree. And then we'll talk about changes in the shape of the yield curve. All right. So volatility of rates. The curriculum basically says straight bond values are not affected by volatility of interest rates, and we're going to take their word for it. There is potentially some technical inaccuracy there, but we are not concerned about that. That's what the curriculum says. So if you look at a binomial interest rate tree, if you increase the volatility, remember that is assumed volatility. If you increase the volatility, yeah, the tree gets more fanned out, but you're still taking the average, and therefore you end up with the same straight bond value. However, the embedded options are obviously affected by changes in volatility in the market, volatility of interest rates. Remember, volatility is a friend of options. So both call options and put option on bonds are positively affected by interest rate volatility. Higher volatility, value of those options increase. For a callable bond, because the investor is short the option, when the value of the call option increases, the callable bond value will decrease.
Because it stops out.
That is the relationship that you need to keep in mind. Conversely, when the volatility goes up for a puttable bond, because the value of the put option increases, the puttable bond value will also increase, again, because the investor is long the put option. All right. So a Bermudian style 3-year, 4.25% annual coupon bond is callable at par, and it's callable at time period 1 and 2.
Okay. It's valued at that when the interest rate volatility is 10. Interest rate volatility then changes to 15. So it is a callable bond and volatility increases. So for callable bond, when volatility increases, is your upside is limited because the issuer is just going to call the bond when bond prices go up and yields come down. And that is the only upside. So the value of the new bond has to be less than 101.5, which is the value of the straight bond.
Value if you at 101.54. When the interest rate volatility is 10%. So when the volatility was 10%, the price was 101.54. Now what happens is, let's say after issuance, the very next day or very next hour, the market interest rate volatility jumps to 15% instead of 10. So when that happens, what will be the impact on the value of this bond? Remember, this is a callable bond. So when the volatility goes up, the callable bond value will decrease. So it will be less than the 101.54. How much will it decrease? We are not asked to calculate. Just recognizing that there is a short call embedded within that callable bond, and as volatility increases, the value of that option will increase, resulting in decline in the value of the callable. All right. Now,
we've got a Bermudan style 3-year 4.25% annual coupon bond puttable at par 1 year and 2 years from now, and it's valued at 101.54 when the interest rate volatility is 10%. So it's puttable, Bermudan style, which means you can exercise whenever after the date. When the interest rate vol is 10%, it's 101.5. Interest rate volatility then doubles to 20% instead of 10. The new value of the puttable bond is less than the straight, equals to the straight, or more than the straight. Okay. Well, for a puttable bond, it's the right to sell. When volatility increases, then the probability of this increasing is unlimited. So the value of the puttable bond increases. So definitely C.
One change. Bond is now a puttable bond. Again, the price is still the same, and volatility goes from 10 to 20%. Well, increase in volatility, increase in value of the put option. Because the embedded put is a long option, we add the value of the put to the straight bond, and therefore, as the volatility increases, the value of the puttable bond will increase, and it'll go above. So this should be 102.522. It's a typo. Original price was 102.522, and obviously with increase in volatility, the price would go above that 102.522. All right, now let's talk about the shape, level and shape of the yield curve. So we are going to start with an implicit assumption that the yield curve shape is upward sloping. That's how the curriculum assumes. On the exam, I expect the exam writers to specify the shape to you. Now, we recognize that a callable bond is a short call option, which limits its upside when rates go down. Normally, so if I were to draw price yield relationship, and this is something that should be familiar to you from level 1. So for a callable bond, you have negative convexity at low rates, and that's where the price compression occurs because of the ceiling based on the call price. So nobody wants to buy the bond if it's going to be called back at call price tomorrow. So nobody wants to buy that bond at a higher price.
Okay.
So a straight bond would not have that negative convexity, it will have positive convexity throughout. So a puttable bond, on the other hand, has a floor on the price at the put price. And that floor is
limits your downside.
The put option affords a protection in the rising interest rate scenario. So the downside on a puttable is limited when rate.
Let me actually put this in. It's quite good.
price should fall, but because it is puttable, it can't fall below the put price. Below the floor. All right. Now, when a yield curve steepens, so if it is upward sloping and it becomes steeper, in essence, what is going on? The rates are rising. When the rates are rising, normally normally the bond price would fall. So call option is unlikely to be exercised. When the bond values fall, issuer is not going to call back the bond and refinance it at higher rates. So the call option is unlikely to be exercised, and so the price decrease for a callable bond has no protection. But the put option value becomes more valuable. So two different things. First, the option value for a call will decrease because it is unlikely to be called, but the straight bond value also decreases. So we are looking at a callable bond value decreasing just because of the rising rates. For a put option, puttable bond, the put option provides protection. So while the straight bond value will decrease because rates are rising, the put option value will increase, and essentially that is the minimum, at the lowest it can go is the floor price, which is the put price. Conversely, if the yield curve flattens, where rates are dropping, in that case, a call option becomes more valuable because the issuer can exercise it. When the call option becomes more valuable, the callable will decline in value. Conversely, a put option becomes less valuable when rates decrease because the investor does not want to put back the bond at the put price if the market price is higher. So that is the relationship between changes in yield curve and the value of the embedded options and the value of callable and puttable bonds.
Okay, there are no questions on that. So oh, these are just masterclass. I'm on 21%. I'm so tired though. So I'm on 65% for quants, 70% for fixed income, 65% for ethics. Oh, I'm moving like an accountant when it comes to ethics, and I'm proud. And I'm proud too of myself. How could I have only answered 26% of quant questions when I'm done with the topic? Oh, it's counting the exam questions. Oh, that bores me. That bores me to the core. Okay. Okay, so there's option adjusted spread. And then there's a quiz. Oh, they've combined the second leg of embedded options with the option adjusted, so I need to do that. So And then we get on to duration. After duration is key rate duration. Then you get capped and floored floaters. There's a lot of math there. It should be fun. Then there's convertible bonds. And then there's credit risk measures. Then there's analysis of credit risk. Then there's credit scoring. And then there's structural and reduced form models. Oh God. And then there's credit spread analysis. Then there's credit spread. Oh, then there's credit analysis of securitized debt. So that's asset-backed loans. And then there's CDS features and terms. And then there's factors affecting CDS pricing. And then there's CDS usage. And then I'm done with fixed income. Fixed income is actually the biggest with 82 activities. I lie. Financial statement analysis is the biggest. Let me see once I'm done with this. Where would I be? I'd be at 26%. So these three make up 26. After fixed income, it's either I do derivatives or I do economics. Yeah. Okay. I'm calling it a day. I've been up since 6:30. Anything I do now will not make sense to me tomorrow, so it'll be a waste. Yeah. I'm on book 2. It's coming along very nicely. I was actually taking another book at work. So this is book 2. I'm near the end of book 2. What is this? Okay. Thanks, guys.